If you own a car in the US, you are legally required to carry insurance. Most drivers accept this, set up autopay, and treat their monthly premium like an unavoidable fixed utility bill, right next to the water and electricity. But treating it passively comes with a steep cost. By simply letting policies renew on autopilot without checking the math, the average driver overpays by hundreds of dollars every single year for coverage that isn't optimized for their actual situation. This chart shows the steep average rise in U.S. auto insurance costs over the past 5 years. If you aren't checking these rates, you are paying a convenience tax, a hidden financial penalty applied directly to your wallet simply for renewing your policy without questioning the price. Every policy involves a strict trade-off. You are balancing your monthly cash flow, the premium you pay out today, against the emergency liquidity you will need tomorrow, which is determined by your deductibles and coverage limits if you actually crash. Mapping how the system actually prices your risk allows you to reclaim that lost margin. When these factors are fully optimized, it's possible to identify $500 or more in annual overpayments. Car insurance is a highly customizable risk transfer contract. When you understand the levers, you control the costs. When you ignore them, your laziness directly subsidizes the insurance company. To optimize that contract, we have to strip away the marketing jargon and look at the 3 foundational coverage tiers. The first is liability insurance. This is the state-mandated minimum, and it strictly covers the damage and injuries you cause to other people in an accident. Selecting the minimum legal coverage secures the lowest possible monthly premium. The trade-off is that you get absolutely zero protection for your own vehicle, leaving you fully exposed to devastating out-of-pocket replacement costs. The second tier is collision coverage. This pays for the damage to your own car after an accident. The third is comprehensive coverage, which protects your asset from non-accident threats like theft, fire, natural disasters, or vandalism. This matrix shows how coverage tiers interact. Full coverage isn't a distinct policy, it's an industry package. When you stack liability, collision, and comprehensive together, you get full coverage. Securing maximum protection across all 3 guarantees the highest possible premium. Every individual tier you add is a direct transfer of risk. You're moving the financial burden from your personal bank account to the insurer, and you pay a monthly fee for that privilege. Insurance providers calculate that exact fee using algorithms that assess risk. You aren't getting a flat rate assigned by a human. You are getting a mathematical score. The most obvious variable the algorithm checks is your driving record. Accidents and traffic tickets heavily penalize your score and immediately drive up your costs. This graph illustrates a hidden, misunderstood pricing factor: credit scores. Allowing your credit score to drop automatically dumps you into a higher risk pool, triggering a steep premium penalty, completely independent of how safely you actually drive. Demographics carry weight too. Age and driving experience dictate baseline rates, making younger drivers inherently more expensive to insure because the algorithm lacks long-term data. Where you park also matters. Living in an urban zip code with high traffic density or elevated crime rates will automatically increase your baseline cost. Your monthly premium is a cold, mathematical reflection of your entire lifestyle risk profile, not an evaluation of your driving skill. Since the price is built by an algorithm, you can actively manipulate the inputs to reclaim your money. This scatter plot maps out strategies by effort and financial impact. The most immediate lever is deductible optimization. Raising your deductible drops your monthly premium immediately, but forces you to maintain strict liquid emergency savings to access coverage if you crash. The next strategy is forced competition. Never accept the first renewal offer without comparing at least 3 to 5 quotes from different providers. Both comparing quotes and bundling policies plot directly into the high-effort, high-impact quadrant of our chart. Combining your auto insurance with home or renter's policies unlocks deep algorithmic discounts. The catch is that it requires upfront administrative time and the friction of actually switching providers. You can also ask providers to manually apply low-effort automated discounts, like reductions for a safe driver, maintaining good grades, or logging low annual mileage. Capturing these major savings requires you to actively force the algorithms to work in your favor, rather than passively accepting the default renewal price. Even armed with these strategies, you can easily negate all of your savings if you fall into a few common execution traps. The most dangerous trap is blindly selecting the cheapest possible liability plan without understanding the math. You save $50 a month, but you accept crippling out-of-pocket limits that can bankrupt you in a serious accident. This decision tree maps out the optimal efficiency for an older, paid-off car. For low-value vehicles, the annual cost of holding comprehensive and collision coverage often outweighs the maximum possible payout the insurer would ever hand you. Conversely, this side maps the protection strategy for a new or financed car. Protecting a highly valuable asset requires full coverage. To manage the inevitable premium bloat, you must aggressively raise your deductible as high as your cash savings allow. Whichever map you follow, it is vital to update your policy annually to reflect your car's depreciation, improvements in your credit score, or a shorter daily commute. Saving $500 is the direct financial reward for treating your auto insurance as an active wealth preservation strategy instead of a passive tax.